Find out what equity derivatives are and how they are traded. A derivative is a financial contract between two parties containing terms of the trade. An equity derivative is a financial instrument that derives its value from individual stocks or stock indices. It is actively traded on the stock exchange. Equity derivatives are of two types: futures and options. Equity futures contracts are those where traders are obligated to buy or sell the underlying asset at a predetermined future date and price, whether they are in profits or losses. An option contract gives the buyer of an option the right but not the obligation to buy or sell the underlying asset at a specific price on a certain date. Option buyers can limit their losses by not exercising their rights to buy or sell an asset. For option sellers, the losses could be unlimited. Options are further categorized as call option and put option. Call option gives the buyer of the call option the right to buy an underlying asset at a fixed price and on a fixed date. Put option gives the buyer the right to sell the underlying asset at predetermined price and on fixed date. Derivatives can be used to leverage trades or as risk management tools for hedging. Traders can also speculate the future value of assets. Derivative contracts are normally more liquid than the underlying asset. Do your research and arrange for the margin amount needed to conduct the trade. Make the transaction through your trading account by paying the margin amount. You can trade on or before the contract expiry date. Buyer of an option needs to pay only the premium, while sellers need to pay the margin amount, same as buying or selling futures.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.